Dividend investors, bonjour, Mike Yahoo here. I'm here to help you invest with more conviction so you can enjoy your retirement. Welcome to this channel. Today, we are looking at one of my non-dividend paying stocks. So every 2 weeks, I'm covering one of my holdings in my portfolio for my pension plan. You can actually head down to the description below if you want to see the full portfolio. Every month on the Dividend Guy blog, I tell you what I do in terms of trade, all my position in terms of money, my returns, my dividend, it's all there. And today, we're talking about Walt Disney. And it's kind of funny because when I started dividend investing around 2010, I had to set myself a set of rules, right? So you have like some metrics, and then you decide if you want to go for high yield stocks or for dividend growth. And back then, when I first started, I had a minimum yield of 3%. So anything under 3%, I used to discard them right away. And after a few years, I realized that there were like plenty of great gem when you look for companies with low yield but high growth perspective. And this is how I ended up buying Disney back in 2014 actually, and I bought more shares in 2017. The thing is, among those rules, I also had one of the golden rule about dividend cut, or in this case, a full dividend suspension. Whenever a company would cut its dividend, didn't happen very often in my portfolio, but I would just sell it in a heartbeat. No question asked, just rip off the band-aid and move on. This time, I decided to keep it. Why? Because it was not really their fault. For a rare occasion, the business model wasn't flawed, but rather they hit the pandemic. So today we look at Walt Disney, pro rating of 4, but dividend safety score of 1, because obviously there are no dividends paid. I'll tell you about the business model, and I'll tell you why I kept it this one, what's their role in my portfolio. And I would like also to take a pause and ask you in the comment, do you have like any stocks like this that do not necessarily fit your overall strategy, but you decide to keep them anyway for other reasons? In this case, for Disney, it's because they have a lot of growth potential. But let's first take a look back of what does it look like in terms of business model. So Disney doesn't need presentation. The company, they have theme parks, they have movies. Most of the time, actually, they own the blockbusters, like the top 10. There's like many years, for the past 10 years, something like that. For the top 10, they have like 5 or 6 title among them. So they are really the emperor of content. With the pandemic, you can see the difference between 2019 and 2021. Disney Media Entertainment, including the streaming services, now it has completely burst. It has like surged big time, but have in mind that before in 2019, you had studio entertainment and then media network that were not combined together. Now they are combined together. So it's not like they doubled really in terms of revenue of income, but it is a growth part of their strategy. Actually, it's kind of interesting because they launched Disney Plus in 2019. At the end of 2019, it's kind of like they felt that the pandemic was right around the corner. Great timing for them. At first, they wanted to have like specific numbers in terms of subscribers by 2024. And actually, they kind of like completely destroyed their goal within 18 months, which is great. Now they show roughly 80% of all subscribers versus Netflix, which is very good. However, you have to consider that many of those subscribers to Disney Plus, yes, they're paying members, but they don't pay much. They're like based in Asia, like in Philippines and stuff like that. So it's not as profitable as Disney in terms of revenue. So yes, they have a lot of subscribers, especially because they have Hulu, they have ESPN Plus, and they have Disney Plus, but still it is a business segment that is still in development. What really hurt over the past 2 years is obviously everything related to movies, everything related to park, cruises. I mean, they're not even making cruises today, right? So it is a very, very rough time for Disney. And this is one of the reasons that it hasn't benefited from the bull market last year. While the market was up almost 30%, they were down double digits. So yeah, it kind of sucks if you're a shareholder right now. I've been there, but fortunately for me, I bought it a long time ago, so I'm still in positive territories when I look at my holdings. But yet, we all prefer to have companies that are doing well all the time, right? One of the reasons why I decided to keep Disney, and this is pretty much my investment thesis, is all those nice images on my right. What are those? Those are all the source of content that Disney has. And what's amazing about those is we all know how great they are with content, creating all kind of movies, series, apparel, theme park, songs. Pretty much everything for every character, every idea is being multiplied into numerous streams of income. Now that they have acquired Fox assets, they're even bigger. And actually, if you've been on Disney Plus, you can see that they're adding more and more content. So it makes it a little bit more interesting today. And going forward, I think it's going to be even better. And what we see with Netflix right now is Netflix is slowly but surely increasing their price all the time. And I can see Disney doing exactly the same thing. Since they have the largest library of content, they have one of the most popular characters across the TV and movie industries. I think it will be very easy for them to continue to grow their subscription base and actually add more paying subscribers and increase the price over time. So it's a long-term project. They already announced that they will invest billions every single years in content creation, which I think it's key. The other thing also that the other reason why I keep this stock in my portfolio right now is, yes, the stock is not doing well, but it's pretty much at the worst possible time. What you see at the company right now, and they went back in profit in 2021, it's pretty much the worst situation they will be for several years. Moving forward, we're going to have more people in parks. We're going to have the movie industry getting healthier and healthier. People will go back to the movies. Yes, Omicron is here right now in January 2022 at the time of recording this video, but I don't think this is a long-term situation. I think in 10 years from now, we're going to look back and say, oh my God, I was so lucky that I've held onto my shares of Disney. And I think this is what's going to happen. So the market is being picky. They were getting greedy and they are getting demanding a lot, especially for the streaming business. It's pretty much right now what holds the business model. But going for the long run, it's not just going to be about streaming. It's going to be about everything else that Disney has always been. And now that they're already back to profit, I think they're just going to move forward and grow even better. They have enough liquidity to keep investing. They're not losing money anymore. So I think that with more content, they will attract more subscribers. They will attract more people to their park team. And once the movie theaters open fully, they're going to make a lot more money also with blockbuster movies like with Star Wars, with Marvel, with other like Disney and Pixar. There are like so many other ways they can make money. And this is why I decided to keep it. Now, the role of this company in my portfolio, well, obviously it's not for income, right? It's definitely a growth stock. You can see that over the past 5 years in the dividend triangle, the stock price went up and down several times. So you have to be ready for a roller coaster. I think that $150 is pretty much a very interesting price to get in. If you haven't been there yet, you can see that both revenue and earnings got severely hit during COVID time, which totally makes sense. But you can also see that now they're going back into growth mode. It's going to take a while before they recover and they look like it was back in 2019, but it's not the first time that Disney has taken a hit, that analysts kind of like say, oh, we don't like Disney for this and that reason. When I first bought it back in 2014, the whole story was about ESPN and people cutting down cables. Well, now it turns out that yes, people are cutting down cables, but ESPN is still making money. And you know what? Disney has moved towards streaming services. They have ESPN Plus, and they're getting the best out of it at the same time. So it proves the ability from management, from the company to move, to adapt. And this is one thing that I really like when I look at a company is how they react to challenges. You know, it's really easy to make money when everything goes well and there's unicorns and rainbows. But when it rains, you need to know what the company is capable of, and they are proving us that they are able to shift their business model, to make the right decision. And actually, I don't think they're going to go back with a dividend model anytime soon. I think that they will reinvest all that money. Keep in mind that they were paying over $1 billion per year in dividend. So I'd rather have them use that $1 billion to create more movies and more series, so that will attract a lot more customers than getting a 1% yield in my portfolio. Obviously, this is not about my entire strategy. I would not keep 10 stocks like that in my portfolio, but am I willing to keep 1 or 2 companies that do not pay dividend right now? Yes, definitely, because Disney has the potential to go back to this model in a long-term scheme, probably in 3, 4, 5 years, once the dividends, the streaming services are highly profitable and they have they're like good number 2 behind Netflix. That would happen according to what I think. So I hope that you have enjoyed this video. I really would like to you to go in the comment, tell me about which stock does not fit your investing strategy, but you still keep it. Tell me a little bit more about it. Maybe we're going to discover some interesting company at the same time. Maybe they are like some great stocks that are not paying dividend, but could fit well in one's portfolio. And until the next video, of course, stay invested.